We're taking a look at the currency market with Shireen Darmalingham, Macroeconomic Strategist at Standard Bank. Shireen, thanks so much for joining us this morning. Let's get straight into it because we've had all global risky assets rallying pretty strongly, and this putting the dollar rand in the low 770s this morning, having broken through that key support which sat at 778. What are you making of the kind of momentum we're seeing right now, and what are your expectations for today's trading day at least?
Well, yesterday we did see the rand continue to make gains on the back of the fact that Euro's optimism around the Eurozone debt agreement continued to linger, and not even the worse than expected PPI data managed to deter rand bulls yesterday. So we do expect, with very little data, well, no data coming out today, for the rand to continue tracking developments in the United States and the Eurozone. So the stage is really set for further rand appreciation today as sentiment remains strongly positive. We do expect that if rand bulls breach 770 to the downside, that a move towards 765 is entirely plausible.
Well, the last time the Dow and the Euro were trading at current levels, we had the dollar rand trading under 7. In other words, the rand, like its emerging market counterparts, has lagged the recovery substantially. What are you making of the kind of dynamic and this lag effect that's currently in play?
Well, there is room for some catch-up, but we do believe that the South African rand is has very different dynamics to other emerging market economies, and doesn't really play out the same as other emerging market currencies on the back of the fact that it's a more liquid currency. So we don't really look, it may not really catch up. We may actually see it really tracking developments in the international world as opposed to local fundamentals that could be driving the currency. So we do see that the currency could potentially still weaken towards the end of the year, and a move towards 820 is what we have currently penciled in.
With that being the status of the rand, what have you read into the kind of commentary we've heard from Treasury this week? Yesterday, South Africa further relaxing exchange controls where companies can now invest more abroad.
Well, initially we could possibly see it being negative for the currency, but in the longer term it could be quite positive in terms of inflows coming back into South Africa in terms of dividend yields, and that could obviously have an impact on our current account balance, which is currently expected to widen. But if we do see that inflows really come through quite strongly, we could see that the current account balance obviously contract from the current levels that we have penciled in.
Also, aside from those investors looking for dividend or higher dividends, outflows are to be offset by yield-seeking capital as well, according to many analysts out there. You touched on that worse than expected PPI number coming in yesterday at 10.5% year on year for September. Has that changed your outlook on the rate side of things at all?
No, it hasn't. We have currently penciled in a rate hike in the third quarter of next year. We don't believe that the current PPI number, which came in at 10.5% last month from the previous level, we do see that the Reserve Bank is cognizant of the fact that inflation is increasing, but we do expect that the pass-through effect to CPI is only likely in the next couple of months. However, we do see a breach of the inflation target towards the end of this year, but it's only likely to be temporary. And due to that fact, we are only pricing in a rate hike towards the end of next year. Currently, we are not pricing in any rate cuts for this year.